What's good, Oos? It's your boy Sham, the BJJ lender, back again. Today, we're passing guard on the tax code and taking the back of the IRS using two of my favorite tools in real estate, depreciation and cost segregation. Now, if you own investment property and you're not taking depreciation, the IRS still assumes you are. And when you sell, they'll hit you with the recapture taxes like you did. So if you skip it, that's on you. Don't let the IRS mount you. We're taking the back, securing our hooks, and choking them out with strategy. Now hit my damn intro. Items. Let's start with the basics. Depreciation is the IRS acknowledging that buildings wear down over time. If you own a rental or commercial property, you get to deduct a portion of the building's value each year, basically writing off the wear and tear. The default method is called straight line depreciation. It's slow and steady, 27.5 years for a residential rental property, 39 years for commercial property. It's clean, it's predictable, but it's slow. That's like being stuck in closed guard forever. Yeah, you can win from there, but it's a grind. Then we've got accelerated depreciation. This is where you use a cost segregation study to break your property into different components and reclassify the stuff that wears out faster. That's how you pass the guard. You move from defense to offense and start taking deductions sooner instead of waiting decades. What exactly is cost segregation? It's an engineering-based analysis that breaks your property down line by line, because not everything inside a building ages the same way. Your roof might last 30 years, but your appliances, carpet, parking lot, and furniture, those things wear out quick, and the IRS knows it. So, cost segregation studies classify components into three main groups. 5-year property, the inside stuff, that's all your interior assets. Appliances, cabinets, countertops, decorative lightings, blinds, carpet, signage, and office furniture. Even special plumbing or wiring for equipment. All this can usually be depreciated over 5 years. 15-year property, the outside stuff. That's your external improvements, parking lots, sidewalks, curbs, fences, landscape and outdoor lighting, irrigation, retaining walls. Basically, everything that makes your building look good from the outside. You depreciate these over 15 years. And then you have the long life structure, 27.5 or 39 years. Now, this is your core. Your walls, roof, framing, HVAC foundation, the bones of the property. Those stay on the standard 27.5 or 39-year schedule. But here's where it gets fun. Under the One Big Beautiful Bill, also known as the Tax Cuts and Jobs Act, we got bonus depreciation. That means many of those 5, 7, and 15-year items can be expensed immediately in the first year if they qualify. So instead of waiting 27 years to write it off, take the deduction now. That's why you see investors say, I wrote off $200,000 or $300,000 of a $1 million property in year one. That's not cap, y'all. That's cost segregation done right. Here's the thing. This isn't some loophole or tax trick. It's not cheating the system, it's using the system. Depreciation and cost segregation are all about timing. You're not taking more deduction than you deserve. You're just taking it sooner. It's the same total deduction, just front-loaded. That frees up cash flow today to reinvest into more property, more renovations, or even your own business. That's how real investors scale. They don't wait 27 years to breathe. They accelerate their moves and keep their money in motion. All right, let's talk about how to actually run this play clean. Step 1, buy or renovate an income-producing property. That can be residential rentals, multifamily, or commercials. Each qualifies differently, but the principle's the same. Important. This does not apply to your primary residence. Cost seg only works for income generating or business use properties. Step 2, Hire a professional cost segregation firm. Don't cheap out with a random spreadsheet off Google. You want an engineering-based study with documentation and a full report your CPA can use. Step 3, have your CPA implement the study on your return. They'll determine which components qualify for accelerated or bonus depreciation and handle the filings correctly. 4, reinvest your savings. The money you save in taxes, use that to buy your next deal, pay down some debt, or fund long-term wealth vehicles like IULs or annuities. 5, plan your exit. Depreciation lowers your basis, and when you sell, you'll face recapture taxes. But if you plan ahead with strategies like a 1031 exchange or installment sale, you can defer or minimize those taxes. That's what we help our clients do at Fortitude Strategic Wealth. Design the entire play from purchase to exit. So let's bring it home. Straight line depreciation is nice, it's safe, but accelerated depreciation through cost segregation is how you truly guard past the tax code. You're not breaking rules. You're playing the game the way the IRS wrote it, just better. Remember, the goal isn't to make more money, it's to keep more of what you earn. And for real estate investors, cost seg is one of the cleanest, most powerful ways to do that, legally and strategically. Again, if you're earning $300,000 or more, stacking rentals or scaling commercial deals, tap in with me and the Fortitude team. We'll analyze your properties, run your numbers, and see if a cost segregation study makes sense this year. Like, follow, and subscribe on YouTube, TikTok, and Instagram, y'all, at the BJJ Lender, and share this episode with your real estate fam who needs to hear it. Because over here, we don't just roll, we strategize. Until next time, fam, us.